Hi, Paul Baranidja here, founder of Smart Path Wealth Management. Thanks for joining me today as I talk about three of the most popular types of equity compensation plans at tech companies: RSUs, ISOs, and ESPPs. Now, those acronyms alone can make someone's head spin. Don't worry, I'm here to help simplify the complex and explain each of these equity compensation awards in as plain as English as possible. Let's start with RSUs. RSU is short for Restricted Stock Unit. A restricted stock unit is a right to receive stock in a company after you have satisfied certain conditions, the most common being that you have to work for a period of time before receiving any stock. For example, let's say you just got a sign-on bonus at Salesforce. Salesforce may offer you 1,000 RSUs with the shares vesting in 4 years. What this means is that in year 4, you'll receive 1,000 shares of Salesforce.com stock. Pretty simple, right? Now, RSUs are great. In this example, let's say the CRM leader is trading for $150 per share. By being granted 1,000 shares, assuming the stock price doesn't move, you've essentially received a $150,000 bonus. Congratulations. However, there is a caveat. The main purpose of RSUs is for them to be used as a retention tool. If you were to leave your company before the shares vested, you lose out on your stock and you get nothing. There are also tax implications with RSUs, and if you don't plan accordingly, it could be costly. The day your shares vest is the day you'll have a tax liability. And when you receive that $150,000 of stock, you'll actually be taxed like you received a $150,000 cash bonus. The only thing is, you didn't get cash, you got stock. Unfortunately, the IRS doesn't accept stock. So either you'll have to sell some equity or use cash to pay your tax bill. Now, your employer is required to make withholdings to help pay for the tax liability, so you'll be covered there. Where people run into an issue is when their stock value declines significantly. For example, suppose your tax liability upon vesting is $80,000. Now let's say you hold onto your stock and the value of that stock declines to $60,000. Your tax bill doesn't change, it's still 80 grand, but you now owe more than what your stock is worth. So like I said, careful planning is important when dealing with RSUs. Now, let's take a look at stock options, which are a little bit more complex. There's two types of stock options: incentive stock options, or ISOs, and non-qualified stock options. The pros, cons, and tax implications differ quite a bit between the two types of option plans. I'll spend some more time on those details in a later segment. For now, let's dive a little deeper into what an option is. Unlike RSUs, a stock option isn't ownership in a stock. When you own options, you own the right to buy a stock at a set price. Let's pick on Workday this time. Let's say you were granted the right to buy Workday stock at $200 per share. A year from now, the stock is trading for $300 per share. Would you exercise your right to buy the shares at $200? Absolutely, you just received a $100 discount. Now let's say the HCM cloud leader is trading for $100 per share. Would you exercise your option to buy it at $200? No, of course not, but it's not so bad. Since you never owned Workday stock, you technically don't lose any value. Options are awesome in that you get to participate in all the upside, but none of the downside. You also have to keep in mind that options have expiration dates. Once that expiration date comes around, the option becomes worthless. Therefore, you have to keep a close eye on your options to make sure you don't leave any money on the table. Finally, let's move on to ESPPs, or Employee Stock Purchase Plans. ESPPs allow you to invest in the company you work for, and many of these plans let you purchase your company's stock at a discount, such as 15% off of the current market price. It's a pretty sweet plan. Furthermore, if you're allowed to sell the stock as soon as you receive it, you're pretty much getting a guaranteed 15% return on your investment. There aren't too many investments I know where this is possible, so participating in an ESPP is almost a no-brainer. Now, you may be thinking, if I'm getting a discount on the shares, why not just buy as much as I possibly can? Heck, even mortgage the house. Well, unfortunately, you can't do that. You're usually limited to how much you can purchase, such as 10% of your gross income. And what are the tax implications of ESPPs? That discount you receive is considered income, so it's taxed just like your wages would be. Again, your employer is required to withhold the amount of this discount, which may come in the form of cash or reduction in shares. If you decide to hold on to the shares once you receive them, any future gains you have is also subject to capital gains tax. All right, to wrap up, working in tech can be very lucrative as you have the opportunity to become a part owner in the company you work for. However, it can also be very confusing, and if you don't pay close enough attention to your equity compensation, it can be costly. I hope you learned a little bit about your equity compensation today. In a couple days, you'll get another email from me where I'll touch a little bit on strategies to balance the risk and rewards that come with equity compensation. Thank you for watching today as I strive to help you plan better, invest better, and live better.